There are other things that you might be able to use, but this happens to be a great tool. I'm not a salesman for Vantage Point, but just want to point out that when we have a tool like this, we can take advantage of it to find some specific spots at which we can take action and get into a market with the less risk and with the best opportunities. So in looking at these, we have several indicators on this chart. The first one we're going to point out is the blue line that you see there. That's a predicted medium-term exponential moving average of typical price. Typical price is the average of the high, close, and high, low, and close. This is a shorter-term moving average as compared against the 10-day simple moving average of the close. The key to the moving average, of course, is in what direction is it going. In this case right here, we had a long stretch where it went down. In this case here, it moves up. That indicates pretty much the primary, the dominant trend that is going on, and that's the side that you should be on if you are in a position type of trading where you're looking for trend trading. It's not as simple necessarily as just following the blue line, but it kind of comes down to that. There are some criteria that we're going to add as to how to get into the market, but to explain a couple of the other indicators first before we get to that, we have predicted differences. The predicted differences are a comparison of moving average that's predicted and an actual moving average, the blue line for a medium term, the green line for a longer term comparison of moving averages. Now this particular indicator pretty much acts as a momentum indicator and indicates that when it turns, you can see here where the market did turn, and it turns ahead really of it. But what is happening here doesn't mean that the market necessarily is going to immediately turn. You still got to look at this predicted exponential moving average and stick with the blue line. But it does mean that there's a situation where the market was going down, but it is now less strong than it was before. It doesn't mean it's necessarily really weak, but it's getting less weak rather than it was before. And anytime you see that turn where that crossover occurs means that it could be an alert that there is some change coming in the market up above. Also, when you look at this chart, we're going to describe the other indicator here. And the other indicator is the Darrell index. The Darrell index is a gray line that you see there. That is a comparison of the exponential moving averages to simple moving averages, a predicted and an actual, and it forecasts what the price will be in 3 days. If it is the price will be higher, the reading is 1, which is bullish. If lower, it would be a 0 reading, which is bearish. Kind of an important little tool to have in terms of a short-term positioning type of trade, because you'd like to get started on the right foot, when it does take off. And I looked at some other indicators, and sometimes you look at the various ones, the MACD, of stochastics, and so forth, and they also have some information that they can offer, but in some cases they tend to give you some false starts and don't provide you really the best information that you want from a positioning standpoint, precisely where to get. So to find a more precise spot to enter markets, we're going to add onto the indicators already shown the predicted high and the predicted low from Vantage Point. The predicted high that you see there is that kind of that gold line that goes across the tops of the market. The predicted low is that pink or fuchsia line that goes across the bottoms of the market. When when we're looking at that, what this does, it forecasts, as you can see by this very last indicator here, this last line here, that's not actually a candle for the day, but that is the range indicated for tomorrow, what the range will be tomorrow based upon what the price is today, currently, what is going on in terms of volatility and other factors. And so that's very useful information to have, because it kind of shows you at what point you could place a stop. When we look at this, we're going to add 2 cents to, first of all, let me explain. We were going up here. We were going kind of in an upward pattern, the last move in the movement. We were kind of looking for a setback. We're already now approaching this high that we had here, which we can expect that high to put some pressure on any further advance. It's kind of a battleground area where the market has to go pretty strongly to get through it, but more likely to turn backwards. And so we're going to use that predicted low as our kind of our guideline as to where we're going to enter the market. In this case here, we had a predicted low This was on August the 30th at 144.48, and if you look at what goes on that next candle, you can see, well, it also went a little bit lower. So we're going to use this predicted low from this particular date right here to go to in a short position if the market drops 2 cents below that low or 200 pips below that low. We'd like to see that turn change. We want really solid evidence that it is going to turn before we get in. We don't know at that point whether the market would continue on up or if it was going to start breaking. You can see that when we look at that triangle that we had up there earlier, this is that line there, we start to break through that trend line. And when we look at where we have 2 cents below that predicted low of 144.28, that means that we're going to be selling at 142.48. And we did get a fill on that, fairly quickly around the point right in here where we got into that short position and we're able to write it down. To protect ourselves, we're going to keep a stop above the predicted high, actually above the entry point initially. We don't want to lose more than 1 cent, 100 pips, $1,000. That's even stretching it for my account anyway. But where the market could go against us, we want to keep our loss at a minimum. If we're wrong, we're wrong. We get out and we come back another day. So we want to keep it, close enough that it can protect us, but not so close that it bounces us out right away. So 100 pips is what we're going to use as a basis, therefore get an exit, and we're going to keep that 100 points from the initial entry point and then 100 points above the highest predicted high, or the lowest predicted high rather. And the lowest predicted high, you can see that it comes in this particular area right in here. And when we keep it above there, September 13th, this was at 137.68. So that means if the market moves to 138.68, then we would exit the market and we would sit flat until it does something to show us that we can get into an entry. And we then are out as the market did move up, did come out, knocked us out of the short position that we had, and now we're sitting there with a decision as to what to do next, waiting for our next set of signals. If the market had moved up from this point, from this predicted high, if it had gone up to 139.68, somewhere in this vicinity right in here, that means right in here somewhere, we would be a buyer if it got up that high. Probably made that line a little too low right in here. We would be a buyer if it gets into that, because that indicates that trend is now reversing and moving up. But we never actually got to that point, so we did not get a full fill. Also, I'm keeping a very close eye on what is going on with this predicted exponential moving average relative to the actual moving average, and it still tells me that the trend is down. It is below that actual moving average, and so we are not ready to change our position yet, even though we do have a situation, kind of indication here that we get a little bullish feeling from the Darrell index, and we've had